Hey everybody, this is Jim Hiles and welcome to First Capital and Gold Plan 101 Market Mondays, the October the 25th. Beautiful fall weekend out here in the Northeast. I have to tell you, it's about peak for those leaves if you want to get out and take a look. Football's in full swing. It actually feels like fall. I got a little chill last week, so it kind of feels good. Anyway, looking at the markets ending last week, the Dow actually did another record high as well as the S&P. However, it's interesting to note that the tech stocks are 2% below their record. So it's not quite 100% in sync. As a matter of fact, we're seeing value just eking out the growth stock group right now. Oil is up. That's one of the reasons why value stocks, cyclical stocks are up. Demand for oil will probably continue to rise. I've heard $100 oil. Hard to say. It's pretty volatile stuff, but likely to see increases in prices with demand where it is. On that front, Jerome Powell basically says, hey, we're going to taper, reduce our asset purchases. We kind of know that already, but they're not going to increase interest rates. And they still are sticking with this transitory inflation, which I think is likely to be the case. I don't see this coming back to where it was in 2019, particularly if wage inflation takes hold. As I've said many times, I think that is beginning to take hold because we can't find enough workers who want to work. We're looking at this Delta variant. It looks like it's beginning to fade, and the kids may actually get vaccinated. So that could change the nature of things as well. When you look across the globe, China seemed to stave off with Evergrande their default, which is good for their markets. We're in earnings seasons. Wacky seasons of earnings are here. Earnings are expected to rise. So if they don't hit the numbers, you're going to see these stocks pull back, and some of them pull back pretty dramatically. Intel was a good example last week. I think it was down almost 11%. They missed some of the expectations in earnings and sales going forward. So just because we're expecting it doesn't necessarily mean it's going to be an easy climb. Yields are up a little bit, still a little less than 170 on the 10-year. Market seems to be somewhat calmer this past week. It looks like the GDP looks to be at a nice rate, 6.7% annualized. Don't count on that staying up there as we get back to a 2 or 3% economy based on where we are in long-term growth trends. Things are looking good throughout. When you look at the markets from a heat map standpoint, large value is now the outperformer, and you can probably look at anywhere in value and find outperformers. So we're certainly like to see that with the reopening trade. Emotion is coming back into the market a little bit more now. When you look at the greed index, the CNN greed index shows a 67, which means people are getting back into the market. It seemed like everyone was waiting for the seasonality thing of the bad September, the bad October to come true. And as you expect, when everyone seems to think it never seems to happen that way. October turned out to be a decent month, up about 5%. So September was the bad one. But people are feeling better about the markets. That's what we're seeing here. We are risk on across the scoreboard. Long-term investors, stay with your allocations. If you're a risk taker, it's a good time to get in the market a little bit more. We're coming into probably the best time of the year to get invested in the stock market. A number of things out there. Certainly the tax law might change. That could be a detraction from performance, but we don't know yet. We also see the infrastructure bill coming in, we think, this year, but we don't know about that yet either. So it looks like it's stay with it and no reason to change at this point, and we'll keep our eye on it. I hope you have a good week. We'll talk to you soon.